Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Multifamily Investor Show. I'm Paul Peebles. Joining me again, Mr. Michael Becker. Michael, how are you?
Hey, Paul, doing pretty good. How are you today?
I'm doing great. Hey, listen, we have just introduced a sister show to the Old Capital podcast, and it is starring Mr. Michael Becker. Michael, tell us a little bit about your new venture.
I know, Paul. I'm excited about it. It's we're calling it the Multifamily Investing Show with Michael Becker. I know it's a real original name, and you can find out more information about it. We have a show's website, which is a pretty easy URL, which is the multifamilyinvestingshow.com. Just multifamilyinvestingshow.com, and there you can find the shows there. We're doing both in audio and video format at a nice studio in North Dallas. So if you go to the website, you can subscribe both on YouTube or iTunes, or follow us on Facebook as well. So it's really a show, Paul, where I'm hopefully going to bring in some pretty high-level guests that have been doing either selling, owning, operating multifamily properties. Getting some economists in and some other people that are integral in the multifamily business, both in Texas and hopefully nationwide, that have really been doing it a long time, and hopefully share some wisdom from people that have been extremely successful doing this for many years. So we're real excited to kind of have that as a complement to what we've been doing here on the Old Capital podcast for, I guess, the last 5 or 6 years now, Paul.
Yeah, this is the higher level math show that Michael's going to have. We'll take care of the freshmen and sophomores, but Michael's going to have the juniors and seniors, somebody that's maybe has been doing it for a couple of years, to listen from the pros. These are the folks that have been doing it for a lot longer than a year or two or three. These are the people who've been doing it. Well, your second guest on your show, Michael, has been doing it since 1979. So Brian O'Boyle Sr. is Michael Becker's second guest on his show. And this guy is just fascinating. And he sells multifamily properties here in the Dallas-Fort Worth area. He's kind of the legend in this area. And tell me some of the things that some of these folks are going to learn from Brian O'Boyle Sr.
Yeah, this the show we're going to record here right after this intro is Brian and myself, and like you said, Paul, has been here for over 40 years selling multifamily deals. I don't think there's hardly a deal in town he hasn't sold, if not 2 or 3 times in his career. So he's seen a thing or two. So we kind of talk a little bit through history lesson of his time in the business and how the market and our industry really have evolved quite a bit. And I know you had a couple takeaways, Paul, that you really enjoyed from listening to the interview. Maybe you could share those.
Yeah, Brian is absolutely fascinating. Some of the things that he talks about a little bit were just in the Dallas-Fort Worth market, 10 of 12 transactions that he was part of that people made offers, had hard money that needed to get pushed over into the title company. So you didn't have a financing contingency. You had hard money from day one. So I thought that was interesting. Second thing I thought was real interesting, and listen to what Brian talks a little bit about. The biggest source of buyers coming into the Texas market are coming from New York and Los Angeles, because some of those areas they can't evict until January of 2022. So you're in a couple months. Isn't that amazing, Michael? I don't know how people do it.
It's unbelievable. I don't see how people can own and operate properties in markets like that.
Yeah, why do people come to Texas? Is because they don't have to worry about the landlord-tenant changes that happen in some of these states. Probably the last thing, which I thought was very interesting, is you have to have credibility. If you are saying that you're going to buy this building and you're in the middle of the transaction, you've got to execute the way that you've said this to the broker, that's communicated to the seller. There's a deviation. You got to have to kind of honor what your word is. What's your take on that, Michael?
Yeah, no, Brian certainly gave a couple, those plus several other kind of observations and tips and tricks that he's kind of experienced through his 40 plus years in the industry. So I really enjoyed listening to him. I always like talking to people that have been around longer. I feel hell, he's been around almost as long as I've been alive. He's been in the business. So it's good hearing from people that have seen many cycles, many transactions, there's hardly anything he hadn't seen in this business. And hopefully some of his wisdom has come through in the interview, and him and many other guests in the future. We look forward to having him on the new show to really kind of, like I said, to complement the Old Capital podcast that we've been doing for many, many years at this point.
Yeah. So before we turn to Brian O'Boyle Sr., chairman of Newmark, one more time with the address to the show, Michael.
Yeah, I think you guys can find this on iTunes or YouTube or Stitcher, or really any of the podcast platforms. You're probably hearing our voice right now. You can find it there. But the easiest way to go is just to our website, which is multifamilyinvestingshow.com. There's a few buttons on here that you can click to the YouTube or iTunes channels, as well as you follow us on Facebook, or you just watch the video straight from the website. So definitely appreciate anyone who's been listening to the Old Capital podcast for many years. Definitely appreciate it if you give this one a listen and or a watch.
All right, let's watch the video and listen to it. We'll talk to you soon. Thanks, Michael.
Welcome to the Multifamily Investing Show with Michael Becker. Today I'm excited. We have a great guest. Brian O'Boyle Sr. from Newmark is with us. Brian, thank you for joining us.
Nice to be here, Mike.
Yeah. So Brian, you are what's your title again, and what's your company? I'm
vice chairman of Newmark.
You guys keep changing the name of your company, so I keep having to get a new email address for you guys.
You'd want to be the printer. Who's our printer? They changed it so many times.
So Brian's had, I think, 4 different emails on as many years, maybe here recently, because they keep getting bigger and bigger as our industry keeps changing and consolidations and stuff. But Brian, you've been in Texas quite a while, selling multifamily properties. So Brian, when did you guys come to Texas?
I came to Dallas in January of '75, and then I worked for a big company, Owens Corning Fiberglass, for 5 years, and then I went in the apartment brokerage business in June of '79. So I've been doing that for a few years.
Yeah, just a few. Where did you move from? New York, right?
I moved from basically Westchester County, about Ardsley, New York, about 20 miles north of New York City.
Yeah, a little different, I'm sure, coming to Dallas in 1979 or 75, excuse me. But so Brian, you've been around a long time. There's probably not a building in town you haven't sold 2 or 3 times, I'm sure, at this point, if not more. I'm sure you guys have a few annuities that you kind of, every 3 to 4 years it keeps trading, and you get yourself in the middle of it. But, maybe I thought that you could kind of start a little bit, tell us a little bit about kind of Newmark, kind of what do you guys do, kind of maybe some of the sales volumes that you guys have done last year, and as we're wrapping up 2020, going 2021, what does that look like?
I've been with Newmark since December of 2014. In our office, we have 7 different multifamily brokers and a land broker. Last year, we did a little over $2 billion in volume. In the first 10 weeks of this year, we did $1.1 billion, which is normally, that's a pretty good year.
Yeah.
And then pandemic hit, and we did, it came to a screeching halt. So we did basically nothing from April 1 to basically July 1. And then what we started to see is the spigots turned out. I mean, if on April 1 you said, how many more deals would you do this year? I'd probably say, I probably got a better chance of doing 0 deals than what we did. So what we found is that we closed 12 deals since the pandemic started. And then we've got another 12 deals under contract. And the interesting thing was on the 12 that are under contract, basically 10 of those 12 deals had hard money day one.
Yeah.
And, the market's pretty competitive out there. And I think what we saw, there were 2 deals that a seller actually wanted to go the full marketing process. And between those 2 deals, we had 50 tours.
Oh, wow.
Which in this pandemic is a big deal, because the first 12 that we did were basically being the people who were showing up were basically regional or local people, because no one was getting on planes. Yep. Then the second batch, we started to see people getting on the planes. And I would probably say the biggest source of those buyers are coming out of New York, and they're coming out of LA. And I think the biggest reason for that is that a lot of these buyers are looking at some of the local landlord-tenant legislation and where they think the market's going.
Yep.
And so that's why they're bailing out of New York and they're bailing out of LA. And in LA, as an example, and the city council passed an ordinance that you can't evict anybody until January of 2022.
Yeah. So,
that creates a lot of challenges. So you say, why do people look at Dallas and Texas in general? They think that Texas has probably got the most pro-landlord laws in the United States. And that's probably the last place they're going to have to worry about landlord-tenant law changes and what have you. And I think, the other thing that people look at, when I guess here's a good example. If you were renting a U-Haul in LA and driving it to Dallas, that costs $4,000. If you were renting a U-Haul in Dallas and driving it to LA, that's $1,000.
Yeah.
So that might tell you a little bit about. But then I think as we look at the dynamics of, just like the Dallas Chamber now is chasing 79 deals.
Yeah.
And there's a lot of big deals in here. And
big corporate relocations.
Relocations. And why is that? People, a lot of investors before wanted the gateway cities. I want New York's and I want the Californias, the LA's, the San Francisco's, and the transit-oriented development cities. And now what the trend is to go away from that and go to the cities that have less dense but have tremendous growth potential.
Yeah.
And my contention is if you look at the most fiscally challenged states, the more fiscally challenged the state is, then what you're going to see, the evolution, I'm going to put more taxes on there. I'm going to make it more difficult for you to do business. And Dallas is going to be the net beneficiary of a lot of those moves.
So let's go back a little bit. So about 45 years ago, you were one of the first guys to get the hell out of New York and come to Texas, way ahead of the curve. How has our market really changed? I mean, a lot of people that are in this business, maybe even including me, right? I'm in my early 40s. We kind of going, a lot of guys in the business kind of going through the first down cycle. And this one's been different than all the others. It's been deep and short at the same time, but really hasn't impacted the investment sales market too terribly much, short of you sitting at home for 3 months doing nothing and then kind of getting right back. It's kind of like you hit the brake and then all of a sudden you're back at 100 miles again, 5 minutes later. But how's the market evolved? You sold your first deal in 1979, you said. What was that deal like versus kind of like today? And maybe we can kind of talk a little bit of a history lesson on how we kind of evolved from the 70s, the boom cycle of the 80s, the bust of the RTC, back to another boom cycle, right. A bust. You're probably on your fifth or sixth one at this point.
Yeah. So when I first got into business, say June of '79, what I did, where I first started out, was in Oak Cliff in South Dallas.
Yep.
And so I started down there, and then I started evolving to other deals. I went from Class C deals into B deals, and then eventually into Class A deals. But I think as we look at the evolution of pricing along the way, I mean, it's been incredible. I mean, as I look at deals just even 5 years ago, as an example, 5-6 years ago, you could buy anything you wanted in Bachman Lake for $25,000 or $30,000. Now we just did a 2-pipe flat roof chilled water system at $105,000.
In Bachman?
In Bachman. So, or then if you look at the Woodhavens, you could have bought anything out in Woodhaven 5-6 years ago for probably $15,000, and we're doing deals there now, the $80,000 to $100,000. But I think when you compare, how does Dallas compare to other markets? We're still a relatively cheap market.
Yeah.
If you look at what are investment alternatives, and to me, the only thing you can really invest in today is multifamily, and you can invest in maybe industrial.
Sure.
On a risk-related basis, a multifamily, I think, is a much better bet. In other words, what people look at are three things. They look at, okay, if I'm going to invest in something, I want something that people absolutely need. It's a necessity, and so everybody's got to have it, and it creates the wellness. So multifamily is, I think, a beacon of opportunity out there. But I mean, just when we look at, the evolution of pricing, when people say, "Oh my God, I can't believe you could have bought that then," and then in 5 years we talk, "Well, remember you could buy a deal at $80,000 in Woodhaven, and now it just sold for $130,000 or $140,000," and so I think that you're going to continue to see a large in-migration of people. And again, the other thing you're looking at is on single-family homes. The average price of an average single-family home is $299,000. Well, 5 years ago it was $165,000.
Yeah, sure.
But $299,000 is still pretty cheap when you compare other major cities. So in terms of major top 20 markets, Dallas has still got one of the most, reasonable cost of housing. And then what that does, then the difference between owning and renting continues to widen, which just lends itself to more multifamily, opportunities.
Sure.
I think the other question you had, Mike, was, what's the evolution of the buyer? And the evolution of the buyer that I've seen, if you look at where, 5 to 8 years ago, there was a lot of lifestyle type buyer.
Yeah.
And they were buying the $3 to $5 million deal. And now a lot of those groups are buying $50 million deals.
Yeah.
And so, and a lot of them have got the ability to raise money quickly, which enables them to be able to compete with more of the institutional buyers, because the institutional buyers need a lot longer. Like, you're a quick decision maker. You can look at a deal and say, hey, I'm in very quickly.
Because I put my own money up, and either I can raise the capital or I can't.
Right. And so with a lot of these institutional players now, we did a deal that we sold to an institutional buyer up in a northern suburb of Dallas. And it was right during the middle of this pandemic, closed maybe 3 weeks ago. That buyer wasn't even able to get on a plane. They had to rely on their local asset manager. They were basically familiar with the submarket. But these guys can't get on planes, because if they do, then they got to quarantine for 2 weeks or whatever it is. And so the what I call the entrepreneurial buyer, I think, has, even though you're competing with a lot of, the gorillas out there, I think with their ability to raise money quickly, they can still be pretty competitive on the term.
So I think that's probably a function of, or my perception of it, because I'm living proof of what you just talked about, is you go back 8-10 years ago, you got those kind of the investment club type buyer, local people. We'd go out and buy a $5 million deal. I think my first deal was $4 million. I had to raise $1.2 million. I didn't know how the hell I was going to raise $1.2 million. And today we just bought a $90+ million deal and had $27 million in equity. And, 8 years later is kind of where we progressed. But what's happened was we bought that deal. It was a 70s vintage flat roof deal in Garland for like $24,000 a unit. Sold it for, $45,000, $50,000 a unit. I'm sure that today is now, $100,000 a door, give or take. And we sold it too damn early, really, probably. But what it did is I recycled that capital. I doubled or tripled up the money, and I did the next deal, and I doubled that money up because through the last 10 years, I think basically what you're describing in Bachman Lake, prices, basically probably rents have basically doubled, and prices pretty much have tripled, kind of on average. In the Texas markets and Dallas-Fort Worth specifically. So returning this capital, getting more and more, having shows like this, some of the other podcasts out there, the awareness of the space, the ability to crowdfund and taking capital really has kind of completely changed the marketplace. So I'm sure even 15 years ago, you're probably doing deals with guys on the back of the pickup truck signing a contract, right? And that's not the capital. Even the less sophisticated capital is so much more sophisticated today than what it was 15 years ago. So I think that's probably really what's behind it. And maybe that's something that a lot of the people that will watch this don't really kind of understand. Talk a little bit more about the kind of the differences between like a group like mine. How do I act? I could look at a deal versus that institution. I used to could get on an airplane, but like, do institutions put hard money up on a regular basis? What's kind of their investment decision and kind of your perception of a group like mine and our investment decision process?
I think that I prefer, as a broker, you prefer to deal with somebody that is a very quick study and has the ability to make decisions quickly. The difference, you go out and look at a deal and you say, you probably tell me, hey, well, subject to due diligence, this deal fits my deal and I'm all over it. The difference, if you had the tour 1 hour after you took the tour, the guy comes in, he's from Hartford, Connecticut, and he said, very non-committal, I'm going to go back, talk to my committee, and then 2 weeks later, he'll call you back and say, hey, well, we did discuss it in committee today and we decided to pursue it. And I said, well, the guy put it under contract a week ago, So it's all the steps that need to go before they can commit to a deal versus somebody like you. You're a quick fix. You understand opportunities. And that's what enables you to get a lot of deals. And then, as a broker, and we've done a lot of deals together because we know if we're dealing with Michael Becker, you can take that guy to the bank. If he tells you he's in, he's in. Yeah. And the worst thing you can do to a broker is you throw him under the bus and the guy can't perform. Because then all of a sudden the guy has another deal he wants to chase, and the guy realizes, hey, the guy threw me under the bus, and and that really strains that broker principal relationship.
Right. So your job, really, the way I look at it, is twofold. One is you have to deliver the best price and the best economics to your seller, your client, the seller. but really two, or kind of one and 1A really is certainty of execution, right? Because you're going to go to the seller and say, hey, this is my recommendation. We vetted all these people. We had a call, we had a questionnaire. This guy's owned 20 deals in town, and this guy's fresh into town. No one knows who he is, so you want to take the higher price here or the more certainty of execution. And that's kind of the weighing that you're doing. So if I'm coming in, I'm fresh out of town, I'm coming out of the Northeast, and I want to make a name in Texas. What I need to do to catch your team's attention and get kind of to the front of the list.
Well, I think what he has to do, he has to, really respond. If a broker's asking him to do something, or as he had a chance to review information, is promptly review the information, come into town, look at the property, and then whatever he says he's going to do, he's got to perform. Otherwise, what's going to happen, that buyer's going to get put in timeout.
Yeah.
And then timeout is hard to get out of, like with your kids, it takes a while to get out of the timeout chair. But I think if you can have credibility in whatever you say you're going to do, you need to do. Be it good, be it bad.
Yeah.
And then I think if you can show that credibility, because the brokers never want to go to bat for you unless he knows you can perform.
Yeah.
Because the worst thing that can happen, then the seller, you make a recommendation and the seller goes, ballistic. You learn in several different languages what the translation of some stress from the seller.
Yeah, that's funny.
So, and that's the worst thing you want to have happen to you.
So come in town, do what you say you're going to do, act in a timely fashion. And in today's environment, it seems like terms are as important as price. And in today's environment, seemingly most of these deals have non-refundable earnest money,
right,
out of the gate. Speaking of you touched on it briefly a little bit ago, but how has the capital changed in the last, say, 6 months? I know it's not only been kind of like the evolution of the kind of the more private capital guys, firms like myself versus kind of the institutions, but have we seen different types of groups come in from different geographical areas? Or have we seen people that were, previously doing industrial deals or office deals and retail deals come into the multifamily space? What have you kind of seen the last eight or so months?
It's an interesting thing. I also work the equity side of the business where I raise equity for groups. And a lot of that for the most recently have been in new development deals. So to your point, I just raised $17 million for a group on a deal in McKinney.
The ground up construction deal?
Ground up construction deal. And then on that particular deal, that group who put the money up was in office buildings.
Okay.
But they had a provision in their fund that they could do some alternatives, one of which was multifamily. So that same group is saying, I'm not going to be able to put the chances of me putting out, office space money is going to be probably limited.
Yeah.
And yet, so this group wanted to put their foot in the water, and they did it on basically a low-cost basis suburban deal that had a good yield to cost, a reasonable exit price, both on the cap rate and the price point. So to your point, we're seeing more people coming into that space because it's one of the few spaces you can put money in today, because you can't put it in hospitality, you can't put it in retail. And then on the office space, people aren't sure how many people are coming back. I mean, I think in New York, there's 10% of the people that are showing up in the offices. I mean, my office here in Dallas just opened up for the first time this week on Tuesday. And frankly, there's one person in it.
Yeah.
So unless some of the support people who can come in at times where they're not bumping into people, so until those, fundamental changes in that office space are worked out, going to be tough to place money. Same thing with retail, same thing with hospitality.
Are we seeing expectations of returns get lowered too versus, say, a year or two ago, since you're kind of playing a little bit more on the capital raising place versus the investment sales space as much anymore? Are you seeing that steadily kind of decline as the alternatives are a 0% interest rate, maybe an 80 bip treasury?
Well, I mean, it's interesting on pricing, because there was a lot of people when the pandemic hit, they say, we think we're going to see a pricing correction. Of all the deals, of those first 12 deals that we did during the pandemic, there was only one deal, which was a Class C deal, and it had a value decrease of 1.5% to what we said was the pre-pandemic strike price.
Okay.
So out of all those deals, there was basically no correction. in the pricing. I think as we look over the past couple of years, maybe 18 months, as the arena has gotten more competitive, some of the yields have gone down. And I think there's a balance to managing, an investor's expectation, But I still think that if we look at long term, where are the opportunities? I mean, I think there's going to be more opportunities in a place like Dallas than probably anywhere else in the.
But the equity that we're able to place here, are they expecting a couple percentage points lower in a return than they would have maybe 2-3 years ago, just because everything's so difficult now and everything's so tight?
On the new development deals, they're a little bit different. Like the metrics on the suburban deal I was doing, that was probably about roughly almost a 7% yield to cost on trended, maybe 7.20 trended, and those deals are typically 35% equity, so you're not having to have recourse financing, and then the overall multiple on those deals is probably about a 1.9, but there's more risk there than the deals you're doing.
Those metrics don't sound that different than most of the deals I put out right now, and
exactly.
I collect rent day one.
And then I think it's a question of I think with age, your tolerance for as the Italians say, agita, indigestion, become less and less.
Yeah.
In other words, typically when you're in 20s and 30s, you're doing the C's, and then getting your 40s, you want to do the B's, and then you get in the 60s or 50s and 60s, you want more of the A- and what have you, because you want a little bit less management intensive deals and what have you. But I just think there's such tremendous opportunities across the A, B's, and C's.
And what I've observed here, certainly over the last 5-6 years in particular, these cap rates really have come in on top of each other. Where you go back 5 or 6 years ago in Dallas Fort Worth, you could buy a brand new Class A deal for like a 5 cap, a B deal was like 6.5, and a C deal was 8.5. Now, an A deal is like 4.5, a B deal is like 4.75, a C deal is maybe 5, and then you throw a value add component, make those cap rates even lower than what I just quoted. So it's basically you're not really getting compensated for having an older, maybe lesser located asset. Everything's pretty much the same cap rate in today's environment. So I guess really the differentiator is, is there the value add story, which I know every deal you guys put out has the value add story with it, whether it's real or not. And then I guess, kind of the size of the check that you can come out and write, so can you go out and write a $20-30 million check, or are you limited to, $5 to $10 million? So you have to buy older or smaller type assets. Yeah. That's kind of really what I've noticed really kind of changed quite a bit. And, I think a lot of that's really just driven by interest rates. And then the interest in the space is, infinitely more than what it was, a decade ago. Have you noticed in Dallas Fort Worth, we're a market of many markets, so many submarkets. I don't know exactly how many submarkets we have in Dallas Fort Worth, but we have, nearly 800,000 market rate apartment units.
Right.
As one of the major, top handful of markets as far as number of units in the entire country. Have you noticed any sort of changes here recently from like suburban to urban? You read a headline a decade ago, no one's going to live in the suburbs, everyone's going to live downtown. And then now you read the headline, no one wants to live downtown, everyone's in the suburbs. The truth is probably somewhere in the middle. But have you noticed any sort of recent changes to that?
To me, the biggest challenge we have in selling deals is like if it's an urban deal, it's harder to sell that today.
And why is that?
Well, I think a lot of it is that there's so much in the pipeline down there. The rent increases are going to be relatively flat for 12, 18 months. And then, so there's the flight from like the rage was 2-3 years ago. I want infill, I want this. And then all of a sudden it's like, now I want suburbs. I want suburbs, lower cost basis, good school systems.
Yep.
And that's where a lot of the jobs are going out there. I mean, if you look, I was talking to one head of economic development in a very major suburb of Dallas, and he said, we've had more inquiries in the last 4 months about corporate relocations than I had the last 4 years.
Yeah.
I'm chasing 8 deals right now that are anywhere between 500 and 2,500 jobs.
Yeah.
And I have 3 deals we're chasing now that are over 3,000 jobs apiece. So, and basically what it becomes is that those decisions on those relocations, it's not, it's not really a real estate. It's not what's the rent? If I'm paying $40 here, $50, it's really a human resource decision where they're saying, what's my ability to attract talent and retain talent?
Yep.
And so Dallas has a very bright future there.
So I think, sir, some of us that have been here as long as we both have, sometimes it's kind of hard because you get in your day-to-day life and you kind of seeing just deal by deal. We're very transactional, both of us, and the nature of what we do for a living. But, kind of taking a step back, it seemed to me about a decade ago, I was telling people, it felt like Dallas was turning into LA, that we were LA in like 1970. And now it feels like we're LA kind of in the early 80s, where you still have another decade or two of, it's not a cyclical thing. It's a secular shift to the way the marketplace is. And I think you start getting, thousands and thousands of jobs relocated, a dozen times a year. We're going to continue to see the growth. So it just seems like we're going to continue to see rental rate growth. It seemed like the pandemic to me really, with the trends that had started are now getting accelerated because of, all the regulatory issues, and, you can't evict people until another year. So, you got to go 18 months without being able to evict somebody. And, I think all those things are really driving, the Texas boom, and Dallas-Fort Worth is certainly, I think, the center of the bullseye for a lot of the Texas relocations. Maybe kind of shifting as we kind of wrap up the conversation here, 2021 forward, what do you guys see? We're kind of wrapping the year up right now. I'm sure you guys are doing a ton of BOV activity, kind of setting up your traditional NMHC bump. I don't know if we're actually going to do NMHC or not this year.
Zoom bump.
Yeah, maybe we'll do it from our house instead of San Diego this year. I think I still might just go to San Diego just to go. But what do you guys kind of see in the start of the year, and how does that compare to, say, start of 2020?
Well, I think that going into 21, I think we've done a significant number of BOVs in the last 60 days. And I think there's a lot of those deals will materialize into listings. So I think you're going to see more product come on the market in January. I think that, the first quarter will be pretty good. And then as long as interest rates stay down, I think we'll be in pretty good shape. So I think there's still going to be a lot of deals out there to be bought. And I just think that as I look at 21, I think it'll be better. I mean, we had an unusually good first quarter, but I think if you just take that out of the equation, I think you'll see a continuous increase in the business, and all the brokers in town are busy. And then, so
you guys see an activity both from the brand new stuff from the developers as well as down to the workforce housing. Is a mixed bag of everything.
Right. It's a mixed bag. I'd probably say it's probably about a third A's, third B's, third C's. And I think that there's opportunities in every one of those segments. It's a question of, pick a segment, become highly educated in that deal. And the more education, because knowledge is power.
Yep.
And the more educated you can become, you can be, a better sponsor to your investors. And then, just don't get attention deal disorder.
Yeah.
Because you can't medicate that.
That's right. Is there anything that has you kind of concerned more than not? Because it seems almost unrealistic that we aren't going to see more pain. I mean, I think you would have talked to me back in March. I think we both would have thought, man, this is going to be a real painful year. And like, besides us sitting at home for 3 months and then getting right back out in July, seems like we really haven't felt the pain that we should have. And I know there's a lot of stimulus money, and 0% interest rates certainly don't hurt the situation, at least what we do. But is there anything that you're concerned of, or if you are concerned of it, what would be the thing that you're kind of looking out for?
Well, the thing I was concerned about initially is what is the sustainability of those collections? And it went on month after month. We did that. Well, we'll see what happens next month. See what happens next month. And a lot of buyers back in April were saying, well, let's see what happens come September.
Yeah.
And then I think we've seen that for the most part, the collections have remained very consistent. In terms of the political situation, we really haven't seen much of a fallout if it's going to turn out the way it is. I don't really see that as being, depends what's going to happen with, capital gains, but, realistically, I think they'll have a hard time getting that through, because I think they'll split at least one seat in Georgia. And then, I still think there's imputed interest in the sponsorship stuff. There's, step up in basis issues. There's a lack of the step up. But I think we'll get through it. And then as we look at just what are the alternatives to invest in that have stability and less risk. And I still think on a risk-adjusted basis, multifamily has been one of the best deals. When I got in the business in 79, it was great from 79 to 84. Then the airbags went off from from January of 85 to July of 88, and then it came back, and I had a great years from 88 to 2009. Then the airbags went off, the brakes got pumped, and then 2009 was abysmal, and then from then on it was happy days.
And the golden age of apartment ownership and apartment brokerage, I'm sure.
Yeah.
So spoken like a true Dallas broker. Brian, if people want to know more information about you guys or Newmark, or maybe even get on your distribution list for future listings, what's the best way to find out more information?
Just call any one of the brokers that's on our website, and they'd be happy to put you on the list. But take the time to get to know these guys and tell them what you want, what your hot buttons are, and how your capabilities to perform are, because that's how you're going to continue to see the number of deals. That's how, when you're in a competitive bidding situation, that you want that broker to go to bat for you.
Yep.
And the other thing I would say that I've seen some guys make mistakes on is, let's say the broker does a good job, he sells you the deal, and then the seller gets Alzheimer's on the way out and forgets who bought him the deal.
Yeah.
That's probably one of the quickest ways to put your nail in the coffin.
Yeah.
I mean, because every competitive broker says, well, okay, he sold it to the guy. But if some broker sells a deal to you, and assuming he hasn't, upset you along the way, it's normally, it behooves an investor to go back through the same broker.
Yeah.
And because otherwise, I think you really alienate yourself. And at the end of the day, you basically, most brokers will put them in timeout.
Yeah. So you don't want to get in timeout. So Brian, definitely appreciate it. Thank you for coming in, sharing those words of wisdom. I would certainly encourage anyone looking to come in Dallas-Fort Worth. Newmark sells as much or more than almost any other shop in town. So there are a bunch of good guys over there. Certainly transacted several times with Brian and his team. So thank you for coming in, and we'll see you guys next week.
Great.
Thank you.
Take care.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.